Good morning, everybody. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderBait's main platform as well. They're a great way to get exposure to the futures market with limited risk. You can use the link in my timeline to go ahead and get the TraderBait app for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. I'll be doing a summary of this episode with my key takeaways that will be available to download as a PDF. If you're interested in getting this PDF, you can click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. I'll also put a link in the nest above in the spaces. And the PDF will be available and emailed out to everyone who signs up. Now, on to introduce our guests. First, we have Oliver Parsons of Cornerstone Analytics, who probably needs no introduction, but Cornerstone Analytics is a macro oil research firm that analyzes global supply and demand dynamics, geopolitical risks, and critical market developments that impact oil prices and related investments. Oliver is a managing director and founding partner, having joined the firm at inception in 2009. Oliver's clients include private equity funds, hedge funds, institutional and private investors, commodity traders, oil companies, government organizers, and special interest groups. Prior to Cornerstone, Oliver was at JP Morgan in New York City, where he advised on venture and private equity investments that exceeded $30 billion in invested capital during his tenure. Next, we have Leonid Mironov. Leonid is currently the head of materials at Pacat Capital Management in Hong Kong. He has over 17 years of experience in the global commodity and commodity equity space, currently focusing on China and Southeast Asia. Pacat is a Hong Kong-based, long-only, and hedge fund manager investing in China and Asia with an exceptional track record going back to 2000. Next, we have BSB, or Street Bomber. Bomber is a 15-year veteran in the energy industry, spanning from wind farm development to gas midstream. He's been working for the last several years on integrated water networks in the U.S. unconventional basins and is currently chief commercial officer for the largest water midstream company in the Midland Basin, where he focused on M&A and organic growth. He holds a degree in economics from SMU in Dallas, Texas. So welcome, everybody. Thank you so much for coming today and taking time out of your busy day. I know that I definitely appreciate it, and so do our guests. So let's start with Asia first, and how I do this in a round. Leonid and Oliver have been on the spaces before, but if you have any comments on anybody else's comment, please feel free to comment or raise your hand and add to whatever they have to say. But so we'll start with Leonid. We're going to start in Asia first. I wanted to talk, first actually, I wanted to talk about BRICS. So BRICS invited 6 new members: Argentina, Egypt, Iran, Ethiopia, Saudi Arabia, and the UAE. So what does this mean for the oil industry, especially with 3 OPEC members that are producing powerhouses?
Tracy, first of all, thank you for having me again. I think this BRICS development is exceedingly interesting for everyone in the oil and gas space, because on the one hand, we have the dollar dominance of oil and gas trade that has been going on for over 40 years. But of course, the question is there a way out of it for some of the producers or some of the big consumers like China, who are not happy about the situation the way it is right now? Now, obviously, there are a couple of nuances to all of this, right? And first and foremost is the question, is this decision purely political, or are there going to be economical aspects to it? On the purely political front, of course, there is a lot of unity amongst all the BRICS members, that all of them declaring the need for diminishing dollar dominance and focusing on bilateral ties and strengthening bilateral ties and increasing bilateral trade denominated in local currency. But the question always is, what currency would it be and how would that work, right? And I think the answer for right now is it's highly unlikely that this will have a meaningful practical impact. Because at least in the next 3 to 5 years, right? I mean, it's very hard to see things happening beyond incremental increases in settlements in yuan, for example, as China becomes a bigger and bigger importer of oil, and countries like Saudi will find it necessary to at least guide the sort of increase in the amount of oil traded with China beyond just settling in yuan and then swapping that yuan for gold in Shanghai, something that's been going on for a while, and that isn't strictly speaking yuan settlement if you then use yuan to buy gold, right? But rather, as Saudi develops more and more of these projects like this new line city or these more sort of adventurous touristy mega projects that they're building out across the country, China's share of contribution to those projects can be quite considerable in terms of steel production, in terms of construction technology, in terms of quick and efficient construction technology. So Saudi's need for yuan might actually get quite significant by the end of the decade. So they will be incentivized to be using more yuan. At least they'll have more use for said yuan, right? And the need for dollar trading slowly diminishes. Those are sort of fairly natural announced trends that we're seeing right now. Now, the question is, how does this happen? Does it happen just naturally as transactions increase and the need for yuan increases? Do these guys start using more of it? Or is it one of those, let's create a framework first whereby we will formally encourage people to start using bilateral currencies more and more so, because of course dollar is convenient, it is safe, and it's something that's been so dominant. And if you look at like invoicing statistics, for example, like over 90% of global trade is invoiced in dollars, right? And if you look at that, you're like, all right, well, it's actually really hard to walk away from something so dominant and so ubiquitous, right? So I think the BRICS guys are designing that framework that may or may not lead to a common currency in the end. But the thing is, it doesn't actually need to end up being a common currency, as long as there is a framework that is both legal and political that enables participants to freely use mutual currencies in each other markets. So, for example, right now, we have a situation where Russian exported crude has been shipped to India this year. Technically, the payment for that crude has been made in rupees, but these rupees are stuck in Indian banks, right? And they could not be repatriated to Russia and couldn't be swapped out to dollars or anything like that, right? So that's a situation that this BRICS framework is trying to avoid, trying to work out a format that will enable both sides of the transaction to benefit from dual currency. Well, if not circulation, but at least acceptance for international trade. This, of course, has profound implications longer term, right? Once you embed something like this into international relations between these countries, you tend to give bilateral trade a big boost. But of course, these are slow-moving things. It's not like tomorrow we wake up and boom, everybody's trading, in yuan or rupees or whatever. But rather, this will be a slow evolution of practices, right? Key amongst them is invoicing, of course, but also loans, right? And as one of the instruments they've announced is this new, well, not new, but formal BRICS Development Bank, now a new development bank, which will become which is chaired by former Brazil President Dilma Rousseff, that they have taken upon themselves to issue 20 to 30% of new loans in local currency. Didn't say local to whom, but still, it's steps like these that incrementally start to get people a little bit more comfortable and get people using these currencies a little bit more in these bilateral relations. Again, far from being a guaranteed success, far from making sure that we are by default going to hit 2027 or something, and then this all is going to take off. I mean, obviously, we're not there yet, but these are exactly the sort of measured steps that one would take if one were thinking seriously about evolving this and turning away from the dollar. Because, of course, the flip side, of course, of all of this is a lot of BRICS nations are in fact net exporters, right? And they have all this surpluses generated through international trade, right? And these surpluses have historically been held in dollars, and the assets that these surpluses have been delivered into were technically treasuries, right? And it's the BRICS nations that talk quite a lot about turning away from the dollar. They're one of the bigger users of the dollars as parking spaces for their surpluses, and the other way around, right? I mean, as the US is talking about reshoring and bringing more and more production domestically, this kind of by definition means that they expect their own trade deficit to decline, and therefore other countries' surpluses to decline as well, and therefore the flow of these dollars should also lower. For a world where this is happening, it's quite natural for participants in international trade, i.e. countries with a surplus, to start to think about the next phase, the next sort of evolution of all of this. And the oil producing nations, whether BRIC members or not, but especially those that have expressed their desire to join, I think they've gone through this thought exercise and they thought, you know what? Whilst we're not quite sure where this is going to end up and how exactly it will impact us, these are exactly the sort of things that we need to pay attention to and start thinking about.
Thank you very much. And then I kind of want to just look at Russia for a minute here. So since oil and gas sanctions and the price caps have been enacted, has this affected them financially? I mean, I've heard, there's everybody has a different opinion. So I know that you have looked into this. So how are has this affected them? How are they doing? How are they making up for lost revenues if they do have them?
Yeah, I think that's actually a great point. The Russia is now back at making about 17 billion a month in hydrocarbon export revenues, so kind of back within range what you expect them to be, with a sort of slightly elevated oil prices. So I think it's safe to say that in that sense, at least, sanctions didn't work. But for sure, sanctions did have an impact domestically, right? And 2022 has been effectively a lost year on the Russian consumer, where there's been a bit of a buyer's strike on durable goods and cars, because as European and American brands and European brands stopped serving the market, people were putting off purchases of Chinese goods, right? Because the perception of the quality was obviously lower, and there was still hope that this is going to work itself out somehow, and normal service will eventually be resumed, or at least gray import lines will be reintroduced, and this will create a sort of a back to normal economy. Obviously, this hasn't happened, and if anything, the stronghold that Chinese brands now have on the Russian market, both in terms of appliances and in terms of vehicles, is quite significant. So, like a Great Wall is the largest overseas vendor in the Russian automobile market now, with over 16% of the market, right? And I think this is quite instructive, because Russia can sustain a run rate of about 1.5 million passenger vehicles sold a year, and that's a market that Europeans and Americans have actually just walked out on themselves and presented it to the Chinese counterparties. In fact, Great Wall, in its latest report that they've published on August the 30th, they made more money in Russia than their overall profit. So all the other parts of the business ended up being loss-making, but it's the Russian business that made over 1.3 billion yuan, right? And that's quite an interesting development and quite telling, right? I think Chinese automobile vendors are charging Russian consumers twice the prices that you'd be expected to pay in a Shenzhen showroom. And again, it's a center for profits for Chinese producers. But despite all that, despite the sort of the prices, we're seeing very significant wage growth. It's over 5% in real terms, right, in rubles. And of course, I found this interesting in 2014, and it's the same sort of mechanism applies today, that if you have a country that is insulated from import price moves, right, then the currency moves don't really impact consumption all that much, right? So as you saw the ban on European produced cheeses and dairy products and things like that in 2014, once that fed through into the system, then the subsequent moves in the ruble didn't really have an impact on consumption. And it's kind of sort of the same now that most of the consumption is being serviced by either domestic or Chinese producers. All of a sudden, the relative ruble to dollar fluctuations, their impact on consumption behavior is exceedingly muted. Like, given that the ruble devalued almost 20% over the course of a summer, like, the impact seems to be almost non-existent, right? And in fact, all the numbers are pointing up, both in terms of company reportings and in terms of Россtat statistical announcements and data collection. So things like car loans are up 12% on year, like spending in restaurants are up 14%, right? Investments are up 46% in some regions, the ones that are servicing Asian trade, or like Rostov, south of Russia, where big investments are being done in the newly acquired regions. Like, there is sort of almost going back to basic economic theory, right? A country that is starved of investment, upon receiving that investment, whether it's done through market means of allocation or through government initiative, if this investment is productive, it ends up creating economic activity, which is kind of sort of what we're seeing right now broadly, especially in the poorer parts of Russia, who are, for a change, growing more or less in line with national averages. And it's the leadership of Moscow and St. Pete that's been lacking, at least in the first half of the year, but that also seems to be coming back. So I think overall, surprisingly resilient. I think, driven by big government spending, driven by large government welfare programs, by spend on child support, on multifamily support, on obviously people at war. All these financial packages amounted to almost 2 trillion rubles over the course of the first half of the year. And that, quite frankly, is a staggering amount for the Russian economy. And of course, this could not have had an impact, right? And we're seeing that, and we're also seeing that reflected in obviously in the ruble's relative weakness as well. So, but again, I think this is something that we've talked about sort of early last year, that to say that because Russia is energy and food almost self-sufficient, I mean, obviously with caveats, but self-sufficient, right? I mean, that the impact of sanctions will be muted. And I think it's slowly playing out that way. And obviously not without its sharper edges, but so far, that seems to be the picture.
Excellent, thank you. Now moving on to Oliver, and we'll come back and talk about China again. But all right, so Oliver, so we had 3 reports out this week: IEA, and OPEC. They all had wildly different estimates for supply and demand. But I kind of want to talk about the IEA report in specifics, because it said, first, oil demand remains on track to grow by 2.2 million barrels a day in 2023 to 101.8 million barrels per day. And by all accounts, we're going to be well past that by the end of the year. And they also said that they expect energy demand to peak by, I think by the end of this decade. I think specifically they said 2028. And so do you see any scenario where this is even possible?
Well, thank you, Tracy. Always a pleasure. So I think first, right off the bat, we've cautioned our clients for many, many years, decades now, don't believe those agencies. Just because everyone, it's not the conspiracy theory thing, but everyone has an agenda, and that's becoming more true than not, as we notice the various revisions that are all picking up speed. And I've worked with Mike Rothman at Cornerstone here for 14 years. He's been covering oil market research for almost 4 decades now, going to OPEC meetings for 37 years. So he's the old guy in the room with the experience, crunches his own supply demand balances, and I think whatever the IEA wants to say, OPEC kicked them out as a secondary third-party research source last year because they got in their whole spat, and we had our allegation about missing oil, which was really just the IEA was totally underestimating demand on the order of 2.9 billion barrels cumulatively over the course of about 10 years. So they revised those balances February 22 last year. So it just goes to show you, and we can dig into all that, but it's really not to be believed. So I think if you bring up the IEA's demand figure, right? So they're saying by I think the number is that we're going to see a growth of about 3 million barrels per day between now and 2028. So if you believe that the world consumption is only going to grow by about 3 million barrels per day, you're really looking at a growth rate compared to a historical average that is about 1/3 to 1/2 of demand growth normally. So kind of the question is, does any rational person believe that oil demand is only going to grow by half of what it's really done? And the answer is no. I mean, but okay, and why are they saying this? What's the backdrop? I mean, they've capitulated on their supply figures, which have been totally wrong. I mean, they have grossly overestimated supply every year. And it's not even us, getting into a spat with them. It's the facts are the facts. So now they've kind of stepped back on that, realizing U.S. shale isn't the life preserver that everyone thinks. They've been so off with that. Those numbers have just been, it's harmfully wrong to any investor. But now we're seeing, okay, on the demand side, why are they saying that demand is only going to grow by half of what's normal? And it's really, the world's going to be adopting electric vehicles, and we're going to be using solar and wind farms, and that's all kind of pie in the sky stuff. I want a better environment, of course, but there's reality and there's the perception of reality, and we're now seeing that all these forecasts are based on this ideal of, okay, let's get the world into this this green mindset, but it's not playing out. And as recently as last week, we're seeing Germany take down some wind farms to secretly replace it with coal. I mean, that's a fact. We're seeing these nuclear reactors that have been mothballed. Now they're silently being brought back online. So I think when we look at the totality on the supply side and the demand side, we're still facing a massive deficit. And the IEA, when they do backtrack, they do it very quietly. They revise their data as little piecemeal here and there. But ultimately, when we look at the numbers and we keep all the historic numbers, we just see this egregious, I guess we can say a hell-bent idea of forcing the public, forcing the media, forcing everyone to believe that we're going to have this world where we're going to be driving EVs. So I think believing their demand number, our figure for the next 5-6 years is about 6.5 million barrels per day. So we're double what the IEA is saying. So I would say we've been proven right a lot more than not. So that's the answer to that question.
Excellent. So then speaking of the EIA, because I know, you've done a lot of research on that whole missing barrel demand problem in the past, but in their latest report, they're looking at U.S. production to hit over 13.8 million barrels per day in 2024. First, is this even possible? I mean, you know, we're seeing we have 139 rigs taken offline since last year. We went through most of the DUC inventory over the last 3 years, and there's little capex going on. So,
And
is this even possible?
I mean, okay, maybe almost anything's possible, but is it probable? No. And they've been banging that production number, 13.8, 14. If you believed everyone, 2-3 years ago, you would have thought U.S. production should be up to what, 15 by now. And I won't call the individual out, but he's someone who's been making a very big bear case the past couple months. And when we get a sell-off in crude, he gets paraded around CNBC, etc. And I saved his report from June 28th, 2022, so just over a year ago. And he had bands where if you have oil WTI prices at 60 all the way up to 90, you would get US production by the end of this year anywhere from 15 to 20 million barrels per day. We haven't even broken 13. So that's, the story that the press wants to run with. I mean, it fits their agenda about, oil cratering and everything, and so much a glut of supply, all those stupid headlines. But the reality is, people buy into this. I get these questions emailed to me like, oh, well, here's so-and-so making the bear case. And all I do is send, hey, this was his chart from last year. In the worst case scenario, we're supposed to be at 15 million barrels per day. We're not even at 13. So, I think there's a lot of just, call it fuzzy math, call it whatever you want, but people just aren't looking at the data. And the IEA, EIA saying that the US should be at 13.8. I mean, next year, yeah, it can happen, but to your point, what's needed for it to happen? Okay, you need CapEx. I mean, how many, trillions of dollars have been taken out of the space since 2014? Look at what producers are doing today. They're paying down debt and they're giving dividends. No one is really out there seeing, as we saw 2014, a few years before and after. No one is really out there trying to put capital to work, because on one side you have the Biden administration, and this isn't political, but you're told, okay, well, you can't drill, you can't do this, oh, you're going to have a windfall tax. It's like, okay, well, what's my incentive? Capitalism is taken out of the equation. Look at a Venezuela. I mean, you can go down the list and see what happens to production profiles when you take capitalism out of the equation. So these drillers, okay, now they're facing off against an administration that is not promoting production growth, and now we have CapEx expenses have gone through the roof. I mean, look at lending rates today, where we're not in a 0, 1, 2% environment where, money's free. Like, okay, well, now these companies have much higher hurdles to actually go borrow, go drill, and hiring has been an issue. Commodity supply has been an issue. Getting the piping, getting the sand, getting everything that's needed. It's not like you snap your fingers and, hey, here's your new well. And I think on the shale side, what absolutely everyone has forgot about is the geology, which is what is the decline profile of a shale well. I mean, we see Saudi, we see a lot of these conventional basins that have been producing for decades that have very low decline rates. And I mean, you would be shocked how many money managers with a fiduciary responsibility don't have the slightest idea that shale is such a short life resource. So after 1-2 years, you have wells that are declining by 60, 70%. So what do you have to do? Well, you have to go drill another well and another well. And eventually you're this hamster on a wheel. And what happened? Well, COVID happened. and we saw a huge shut in production. And that to us was actually one of the most bullish developments ever. Yeah, oil went negative and it was extremely bearish at that time, but that set up the other side of the coin. So now we have been saying for the past 3 years, we are not going to get this super growth in US shale output because of these decline rates. And we're witnessing it now. And if you believe the forecast for the past few years, we should be at 14, 15, 16 million barrels per day, but we're not. So I think a lot of people have forgot the geology of the rock. And now we're in an inflationary environment, higher capex, an administration that does not want the producers to have any leeway. So the cards are stacked against them in so many regards. So could we hit 12.8? Yeah, but is it probable? I mean, 13.8? Yeah, but I don't think it's probable.
Do you think we were actually at, what did they have this report this today was 12.9? Do you think we're actually at 12.9? Just
I mean, I don't, but we really don't put faith into that weekly number just because it's a model. It's not so you should be paying attention to the 914s, which are released at the end of the last day of every month, and that is actually survey data that is triangulated from the producers. The weekly number that everyone sees Wednesday at 10:30 a.m., which today said 12.9, that's just based on a model. So there's a ton of variability with that model. It sometimes overstates, understates, but to us, we're really not putting much faith in it, and also in the weekly numbers in general. I mean, we had a build today, like, okay, I guess the world's ending, right? Like, but the truth is we're coming off a weekend after a holiday weekend, Labor Day. The numbers are always wonky, and we've seen some of the biggest draws in history over the weekly numbers the past, say 2 months. So like we use it as we keep an eye on it, but we don't put much faith in those weekly numbers.
absolutely would agree with you. Well, and
So-
all the revisions come on the 914 report, but you don't hear about those, right? People only watch the weekly numbers.
Of course. I mean, I tried pulling up the weeklies at 10:30 today, and what happened?
I saw that.
I got a server error.
So did I.
Because everyone and their mom, they're all trading oil right now. So it's like, okay, well, I'm just looking at it to see how big of a laugh I'm gonna get. But that's that's neither here nor there. But I think everyone's looking at these weekly numbers and not realizing it's really not a total indication of what's happening. I mean, you can go down the list and make any bearish argument you want, but the data we're looking at, I mean, look at demand across India, across China, air traffic. I mean, the indicators that we look at show that demand is extremely robust. And your comment about the, the IEA is saying 101.8 million barrels of demand next year. Well, we're already there. And don't believe the IEA's demand numbers because of the whole phenomenon of missing oil, which Mike was proven correct about. I mean, he was banging that drum since 2007, and then he was saying back in 1999, and then back in 87. So, the whole idea of the IEA understating demand is kind of a movie that keeps replaying, and, the next generation doesn't realize or care about it, but it's still going on. So I think there's a lot of nuance in the data and the headlines that are put out there. But look at it big picture, we're seeing strong demand, we're seeing inventories draw globally, and we're seeing supply extremely constrained.
All right, thank you. And we will come back to you, Oliver. I want to move to BSB. or Bomber? I
Yeah,
don't know. Which
I,
nickname
I
do you want
wanted
me
to
to
just
call
kind
you?
of piggyback on what Oliver had to say, and
Yeah.
I think that there's another. I think that there's another kind of aspect here that people are kind of failing to appreciate, and it's really just kind of driven by the market. And so when you look at the U.S. onshore producers, there's a gap in how they're trading. You know, large caps trade better than small and mid caps, and then you've got private equity that's really behind a lot of the growth. And what's continued to happen over the last few years is that there's an arbitrage for a larger company to buy a smaller company, and then they will be able to put their hands on that PDP oil and be able to capture that and trade at a higher value. So you've seen a lot of consolidation from larger companies buying smaller companies, and then from mid-sized companies buying private equity-backed companies for their growth. And before, private equity would come in and they'd really just drill up a few wells in a certain area and prove up the area and get paid for the PUDs, the proved undeveloped wells in the area. And as time's kind of gone on, the PUD value is not worth what it was. So private equity money goes in and they will drill up and get their PDP up as high as possible so they can get a better value for what's known to be there. And so each time that happens, you see rigs fall off and you see frac spreads drop. And you're going to continue to see consolidation across U.S. unconventional basins as capital efficiency is the name of the game. And each time that happens, you've got less and less rigs going into the future. And you don't really see that story being picked up as much. There's always the inventory question. Is the inventory what the inventory is? Are the economics worse? Is inflation happening? Yes, all of that's certainly a factor. But from the sense that there's just less management teams and less operating companies out there performing this work, it's certainly having an impact in the U.S. output of supply.
And do you think, I mean, we've seen a lot of M&As and BKs since obviously 2016. Do you think there's still room for more?
I think that there's a lot of room for more, and it's just kind of funny how cyclical the market is from majors leaving the Permian Basin to coming back in and growing their positions. And there's a handful of companies that are out there that are private that from Endeavor in the Midland Basin to Mewbourne who excuse me, who have older aging owners, and then you've got some very large private companies that have been backed by private equity for a long time and are kind of at the end of their runway. And a lot of those private companies, the especially the family owned ones, still have some of the best inventory left in the basin. And at some point in time, it probably makes sense for them to consolidate, and you'll see the majors picking up those companies. So as that happens, they'll continue to return cash flow to investors and be pretty disciplined in their capital investment.
Do you have any names you think are on the list next? You don't have to say it if you don't want.
I mean, there's always. I mean, I think Endeavor is the one that people probably question the most, and so thank you.
All right. And then I kind of wanted to talk to you. You have some exciting things going on in sustainable water management practices in the oil patch. Can you kind of explain this technology for people that aren't really familiar with it and how this works exactly?
Yeah, absolutely. So our company, there's always been, I guess the best way to say it is, in unconventional basins, the water has been a critical aspect for, how you get to the completions. And as the frac design has changed, there's more and more water that's needed for the frac. Also, when you're exploiting the rock, you get three streams back out. You get crude, you get gas, you get water. And that water has traditionally in the industry been a waste product. And as time's kind of gone on, companies have gone in and laid out pretty extensive infrastructure networks to be able to inject it back into the earth. And so, one of the things that's been really happening over the last 5 or 6 years is treating that produced water to a point that it's clean enough to be able to use it again for completion. So you're essentially sending less water back down hole. And so what we have done is we've gone in and bought a very large infrastructure platform in the Midland Basin, about 1,000 miles of pipe, 90 disposal wells, and a bunch of ponds, and are connecting all of those ponds and disposal wells together and going out and being able to treat and reuse as much water as possible, and then limit disposal. So in the Midland Basin where we're operating, there's been seismicity issues, and people will look toward fracking as the reason for it, and it's really not the fracks that's causing the seismicity. It's injecting produced water into formations that are that have faults associated with them, and then will start to slip. And so, in different basins, you have different water cuts. In the Permian, in the Midland Basin, you're kind of making 3 to 4 barrels of water for every barrel of oil. In the Delaware Basin, you can see it, 6 or 7 times as much water for each barrel of oil. So there's this massive water problem that's holding back production. If we could capture all of the water that we're producing and send 100% of it back for fracs, there's still surplus water that is that needs a home, and it needs to go down hole. And one of the technologies that we've partnered, our company is partnered with Bechtel, is on desalination, where essentially if you make 10 barrels of water, you can take 5 barrels and make desalinated water that you can put back on the ground. Right now, you're not able to do it through regulations, but you can put that water back on the ground or reintroduce it into the water table. It's an emerging technology. So 5 out of 10, 5 barrels are desalinated. You can make 3 barrels of treated produced water to go back to the frac, and about 2 barrels of water that needs to be injected. Well, when you start looking at future technologies in the water, that 2 barrels of fully saturated brine water has a lot of heavy metals and things that at today's concentration, you can't go and pull things like lithium out of. But if you have a concentration down that's all concentrated into 2 barrels out of the 10, you can start to extract minerals out of that water stream. To maybe it's lithium, maybe it's maybe it's some sort of fertilizer, calcium carbonate. There's ammonia plants that are out here, and you can make ammonium sulfate with some of the different components coming out of the water, which is fertilizer. And the downstream markets of the desalinated water game are going to allow people who have access to this technology to sell those downstream products and lower the cost of desalination to bring it back in line with your traditional gathering and disposal. It's going to be more expensive, but the net benefit to the environment of having access to new fresh water and also limiting the amount of disposal that's happening is going to be a huge positive for the Permian Basin, specifically where you're making so much.
It's amazing. Does the government must like this, right?
Yeah, I mean the government doesn't quite know what all can happen with it, and I think that what you've kind of seen over time on the water piece is, you look at companies' ESG scorecards, and everyone's focused on carbon, and no one's focused on water, and there's really not a reason to bring water to the forefront because of some of the problems associated with it. But as companies have continued to get more innovative and figure out how to limit the amount of fresh water that they're using, they've started to set internal goals for recycling demand for their completions. And as technology continues to advance on the beneficial reuse piece, I think you're going to start seeing people elevate it to a level that they want credit for it on the street, because limiting freshwater usage in the Permian Basin, which has been experiencing a pretty significant drought over the last few years, is an amazing story that I think people can get behind.
Yeah, it sounds very exciting. And then we will come back to you. And I want to go to Leonid, I want to talk about just a little bit about China demand. They've had some really strong import numbers this year since March. A lot of people are saying it's all going to storage. Is it all going to storage? What does demand look like there? We all know the property market is a disaster, but are they making up for losses in consumption elsewhere?
Tracy, I think that's the $1 million question. But before we go on to that, can I just say, Mr. Bomber's water idea sounds absolutely amazing. That is, no, I'm extremely impressed, and I will obviously get in touch later to find out more. It sounds. Now, on to the China thing, right? I mean, we've had Chinese data released a couple of days ago saying that overall storage across commercial and strategic reserves peaking at 1.13 billion barrels, which is, an all-time high. So a lot of it is going to storage, but of course there's also a practical use component, because don't forget, a lot of it is being driven by Chinese buying being somewhat bifurcated, right? So you have private companies, teapot refineries mostly, who go out into the market and buy to their own accord, right? And they buy as much as they need whenever they want. Then you have the state players like your CNOOCs and PetroChinas and Sinopec, who, through a combination of their own internal resources and topping up in the market whenever they need to, buy according to the plan that they have previously agreed with the state officials. And then you have the state buying into the reserves. And then you have various actors in between that are sanctioned, or sometimes pretend to be sanctioned by the state in order to carry out a particular policy that state seems is beneficial to the long term or even the short term well-being of the nation, but is not strictly speaking paid for or outright authorized by the state. So, for example, storing barrels offshore China during the COVID oil dump was one of those examples of this middle ground where actors involved were mostly private, but it was clear that the government was very keen on this to happen, right? And so when everybody's buying, you get this run up in price, right? And why are the refineries buying? Because they're making an awful lot of money, right? I mean, you look at what is the best performing oil and gas stock in Asia so far this year. That's PetroChina, total return of 68%, ladies and gentlemen, right? Why? Because it was able to buy cheap Russian oil and sell it at highly elevated crack spreads, most of it in the US, right? The government has helped along by releasing export quotas 3 times this year, and we're almost 40% above the run rate this year so far is about 40% ahead of last year. Now, obviously, these are big numbers. And it looks like maybe there is even talk about the 4th round of quota increases for the year, because the situation persists. These companies can make an awful lot of money by selling refined products in overseas markets, like especially distillates and things like that, right? And in this environment, of course, all the teapots are incentivized to produce as much as they possibly can. And they're not alone, right? I mean, you look at refineries around the region, that seems to be the case, right? And so on top of it, you have the government that clearly made the strategic decision to run with higher. They think in this current environment, the risk to the oil prices is to the upside. That's what Oliver was mentioning, right? I mean, the Chinese are looking at the US situation and they see that, there is a chance of a very big squeeze on the oil price, right? I mean, okay, it's not 100% chance, but there's clearly a chance. So it's prudent, especially it was doubly prudent when the prices were $60 and $70, right? I mean, to buy and store just in case it happens and then release it in the hundreds, which is something they've done before. So I think they will do so again. So you have almost competition amongst Chinese buyers who's going to buy the next barrel. And in that environment, of course, prices have to go up. And of course, with it, you also see the bills, right? Because as refineries increase demand, traders increase storage, and they themselves increase storage, and the state increases the storage. So you end up with record storage as per what they've announced.
And then One other question on Europe. I think this phenomena is really interesting. Demand from Europe seems to be really strong, especially for the product markets, yet manufacturing remains in contraction. So where is this excess demand coming from?
Well, I think that's also a great question, because I find it hard to see what's picking up the slack, right? I think looking into European demand, the thing that really struck me was that we are all at multi-year and sometimes all-time highs in gasoline demand in places like Spain, France, and England, right? And I mean, that I guess we didn't really have on the cards for this year, right? I mean, that's weird. I think maybe it's harder for me to really see good data on private storage. So maybe there's also some kind of stockpiling going on. I don't really know. I can't really see that. But it seems to me that non-industrial demand is really quite strong. It's the chemical businesses that the BASFs of the world that are suffering, or at least their European operations are.
Excellent, thank you. And then back to Oliver. I wanted to talk about, well, we talked about USMN. Let's talk a little bit about your thoughts. Well, I'd like your thoughts on carbon capture. So far, it seems pretty costly and rather unproven, but perhaps you know something that I don't.
I have to say that's not my wheelhouse at all.
Okay.
So I'll
Right.
take a pass on that one.
All right. Oh, that's good.
I could spin a story, but it's not worth your time.
All right. All right. So let's talk about renewables then. Let's talk about renewables. We just had Ørsted is about to abandon wind projects in the U.S. because it said they're just too expensive, or they're going to have to raise prices by 60%, which obviously goes down to the consumer. You have the solar industry in Germany just reported that 15% of their solar capacity is rapidly disintegrating. So what are your thoughts on this? And, you know, will the West kind of finally wake up, or we're just going to keep going after these technologies?
I mean, I think it's a death by a thousand cuts, and we're getting there. And I don't mean to say we're getting there in any positive way. I wish the green agenda was just something that was more, I guess, more realistic. But I think when discussing EVs, you also, well, EVs and green technologies, you have to consider the emerging markets. And on the demand side of the equation, that's what matters. And there really is not great transparent data into emerging market demand. But a lot of people, they'll focus on US and Europe because that data might be readily available. But you know, you have to consider or nations in Africa or China or India, are they going to develop these green policies? I mean, the name of the game is that fossil fuels, and you climb up the ladder of energy efficiency, that provides a better standard of living. So people are starting to realize, I mean, you know, last winter, when we saw, you know, the Nord Stream, all that happened, and nat gas prices went through the roof, and people finally started to make some noise about, okay, you know, these wind farms and EV, they aren't the solution. And now you're going to try to force that down the throats of the emerging markets. So I think a lot of it is virtue signaling. I mean, look at, you know, our numbers on the demand side. They show India year over year, their demand oil consumption is up about 8% for the month of August. China's up anywhere from maybe 15 to 20% or more year over year for the month of August. So, you know, you have a lot of these countries that are the EMs as a whole, their demand consumption has now overtaken the developed markets. So everyone kind of ignores that side. So I think as demand continues to grow, we're just going to see the green story just keep falling flat.
And then what are your thoughts on offshore right now?
I mean, it really has the highest cost profile, right? So, you know, when you look at where is your marginal barrel going to come from? Is it going to be offshore? Right off the bat, the answer is no. But we're looking at, you know, if you look at the drillers, I mean, that's a lot of the beta play in this space because those companies, you know, a lot of them went under, restructured, coming through the 2014 collapse. So now we're seeing some traction in those names, you know. But when you look at some of the offshore fields and the argument that Guyana or whatever countries you want to choose, are they going to be the solution to supply growth? And we don't think so. Also, because a lot of those companies, it has a long runway to get production out of the ground. So you know, we look at Brazil. I mean, Brazil's production profile every year it gets pushed back. I mean, you know, it's kind of like a hockey stick where your growth, your production growth is up and to the right, but that just keeps getting pushed back every single year, and we have seen that for so many years. So, you know, I think a lot of it is kind of people wanting to manifest it into reality, but that's not what we're seeing. So when we look at the really what's happening on the production side, I mean, you have to look at OPEC and then non-OPEC, and really, okay, where is the supply going to come from? Well, non-OPEC is really always trying to produce at full capacity. OPEC, we're seeing restraint from Saudi, and we've had, you know, we've always had an argument that Saudi production is well below what the consensus thinks. You know, and then we have countries like totally off everyone's radar, like Nigeria, Angola. I mean, those two countries alone, the past, say, 10 years, they've lost about 1.5 million in production between them. And like, no one's talking about that. So, you know, you have Russia. Like, Russia is right now, they're about a million barrels a day under their quota. That's not because they're doing the market a favor. Like, they're not doing that to try to prop up prices. They just announced the extension of their 300,000 barrel per day cut as well. And our contention has been, well, you kind of have the Western companies out of Russia. You aren't having any of the downhole work done, the refinery work done. So you're starting to see a natural decline in Russia, which we've actually been saying for well before COVID, that Russia's production profile is going to start turning over. And now we're really starting to see it. So, you know, I think you go down the list of all the producers. You mentioned offshore, but, you know, that's not going to save the day, we don't think. So, you know, take Russia, take Angola, take Nigeria, take Venezuela. I mean, Venezuela is not going to do a damn thing. And people don't understand the geology of that country at all. Their wells are just total garbage. Their infrastructure has been totally stripped. So, you know, everyone wants to make the bear case that Venezuela production is going to, you know, come surging. They started making that case last year. But, you know, we just saw last month a huge drop in Venezuela's production. So we look around the map and we're like, okay, well, Saudi's the only one who has barrels. That's it. And demand's going to keep growing. So we're in Saudis here, and they're you know, they've got discipline, and they're playing the game against the Biden administration. They aren't too happy about the SPR release, and really, in our estimation, part of their cut is just an FU to everyone. So, and they have a budget to meet, right? So they need higher oil prices. So people are kind of forgetting that you have lots of dynamics on the demand side, and it's not just going out, finding a well and pumping the oil. Like, there's so much more to consider.
Thank you very much. And Bomber, back to you. What we haven't really talked about natural gas. Can I ask you about natural
Sure
gas?
thing.
So first, your thoughts on the natural gas market is everybody is wondering, are we going to get over this long-term price of, around $2.50? And then the second part of that question is, do you have any idea what's going on in Freeport right now? Because the feed gas intake's been cut for the fifth day, and, sustained depressed flows kind of suggest to me there might be an ongoing problem at the facility, but companies hasn't said anything.
I don't have. I'd be lying if I had a clue what was going on in Freeport exactly. But you kind of see these upsets happen over time, scheduled maintenance, et cetera. But I think from the natural gas standpoint, you've gotten so much gas that's been bottled up in these different basins. A lot of the gas producers were hedged going into this lower price environment that we're in right now. Started putting on additional hedges as gas was climbing last year, and it really just didn't incentivize anyone to drop rigs like you've seen on the liquid side. In the Permian Basin specifically, though, there's several different residue gas pipelines that are under construction, being built down to the Gulf, down to Freeport, for export. And when those come online, you'll start to see gas prices, kind of climb back up as the LNG facilities are constructed. You've got more takeaway and less, low pricing environments, spot pricing environments at some of the hubs, like Waha hub in West Texas is, it's traded negative, where essentially operators are paying people to take their gas on unhedged molecules, and it's just been really tight. But there's I think 3 different projects that are slated to come online in 2024 and 2025, and everyone that I continue to talk to, operators that we work with, are more bullish on gas prices over the next 24 to 36 months.
Well, that's good news. I'm sure that's good news for everybody that's been waiting for this to break out again. And then, what do you think? What are the best opportunities right now in shale, or is Permian's kind of the darling? Is that the only place to be right now, or are there other basins that look like there are opportunity?
Yeah, I think it kind of just depends on in shale what your thesis is. If you are kind of bearish natural gas, you're staying away from the Marcellus Utica and the Haynesville, which are very gassy plays. If you're bullish oils, you're probably in the Permian, and then the Bakken, and then some of the other more oil-rich basins like the Powder River Basin and the DJ. While they are far lower producers, a lot of the operators that are there are getting good well results, and it just kind of depends on your thesis. If you're a gas bull, then it's kind of the opposite, right? You're looking at basins that have higher gas oil ratios, and or straight dry gas basins where the cost of getting the barrel to the markets is the lowest. And the Haynesville continues to kind of dominate the gas basins from that standpoint.
And then, did you have any thoughts on carbon capture, or no?
I do.
Nobody wants to answer that question.
Personally, I think it's a bit of a pipe dream and a little bit of a joke. I think it's kind of, at this point, it's wasteful spending. The carbon capture technology that's out there right now is extremely energy intensive and not very efficient. And from a water perspective, requires quite a bit of water for the cooling process. And then, as you're going through that water, you can't reuse all of it. You have to wind up injecting and wasting a lot of fresh water for the carbon capture. And I got into it with someone on Twitter the other day that the best carbon capture plant out there is a tree, which also requires water. But the companies like Oxy that have gone all in on carbon capture continue to make me scratch my head, and I think the market's going to realize that it's not quite what it was dreamed up to be.
I would tend to agree, but Oxy just got a bunch of government subsidies for it. So
the carbon capture market's
right?
pretty crazy. These companies that are capturing and injecting carbon One, you get government subsidies to do that. There's also out there a private market for carbon capture. So let's say that I'm a company that's injecting CO2 into the ground. I can get my 45Q credits, but if there's someone out there like an Amazon or Walmart who's wanting to buy carbon credits to go net zero, they can also pay you for the very same molecule that's going downhole, that you're getting 45Q credits, so you can get paid twice. And so to me, it seems like it leads to quite a bit of grift and people that are out there, really just trying to play the game for something that's not making much of a true environmental difference.
Excellent. I tend to agree with you 100%. But I wanted to hear your opinion. All right. So the final round here is the same question for everybody. It is, you can talk about something that we haven't talked about that you wanted to talk about. And, or, what should there's a lot of traders and investors on this space. So, what should we be looking at specifically over the next 12 to 24 months? And we'll start with Leonid.
Well, I continue to bang the drum for Chinese domestic production, right? I mean, that's one thing that people don't pay that much attention for, because China is just such a big net importer. But my base case is that they will be able to get to 5.5 million barrels a day of domestic production by 2026. And as they get closer and closer to that target, obviously their imports are going to slow down somewhat, but also the performance of their big producers obviously is going to be representative of that. And specifically looking at PetroChina in their latest results, their annual production is up almost 8% year on year. Expectation was closest like 2.5 to maybe 3. So they're doing some good work over there, both in terms of developing some of the shale basins, but also more conventional and even sort of shallow offshore projects. There is a mini oil boom happening over there without almost any sort of information being made available to the public, and really the public not taking any interest either.
Thank you very much. And Oliver, same question. You can talk about something that you wanted to touch on that we haven't been able to, and or what should we as investors be looking at 12 to 24 months out?
I mean, so many things that we could talk about this all day, but I'd say one of the key things is just keep your eye on Saudi, keep your eye on their messaging. We said this over 3 years ago that Abdulaziz at the helm is he's bringing order. Everyone along the way has said it's OPEC. They're gonna cheat on quotas, but Saudi is really in control of this game. And the messaging has been extremely clear. It hasn't changed over the past 3 years. And I think that's just something you really need to focus on. And their spare capacity number, I mean, their output number, it's not 12.5 million barrels per day. That's what the IEA has been running up the flagpole, Bloomberg, etc. Our number has it under 11. So this whole notion of this massive spare capacity available to the system, it's not there. So really just keep your eye on Saudi. And then on the investment side, Bomber, I'd like to talk to you and your carbon capture guy, because I think we could get a good grift going there. Thanks, man. That's
all right. Bomber just DM me. His Twitter crashed for the 3rd time during this. So he apologizes. He has to skip the final round. So again, thank you, gentlemen, so much. Please follow everybody up here. They all are great follows on Twitter. And we really appreciate you taking time out of your day to speak with us today. I'm sure that everybody would agree with me on this. And with that, thank you again, and I'll see you guys next Wednesday.
Thank you, Tracy.
Thank you, Tracy. Thank you. Bye.